Hi all, this is Kishori Sharan. I am a qualified chartered accountant with over 2 decades of experience in financing, in controllership, in budgeting, forecasting, planning and analysis, and compliances and controls. Right, my journey has been shaped by diverse roles in leading organizations where I primarily focused on enabling business performance and driving growth. Today, I'm here to discuss the working capital concept. Working capital is one of the most critical aspects of the organization because it impacts directly the liquidity, profitability, and overall operational efficiency of a business. At its core, working capital refers to the difference between the current assets and the current liabilities. It represents the short-term financial health of a company, or in other words, it means how firm is capable of meeting its day-to-day cash requirements. Effective working capital means firm has enough cash to meet its short-term day-to-day cash requirements to run its operations smoothly and efficiently, right? So working capital primarily revolves around not three, in fact, primarily revolves around two concepts. One is the receivables, and another one is the payables. However, from the manufacturing company standpoint, the third concept is the inventory that is also being covered. But yes, for a service organization where there is no inventory, the two concepts, that is the receivables and the payables, which has to be which are to be the key focus upon for working capital management. So let us begin with the discussions over the receivables. Receivables or the account receivables represents the money which is owed owed to the company by its customers. It means that the amount which company is supposed to receive from its customers for the services which it has rendered, right? So now efficient receivable management pertains or means focusing on the time which a debtor is taking to pay the companies back. So efficient working capital management means uh, or it focuses on reducing the time to collect the cash. This is called DSO. DSO means daily sales outstanding, or the day sales outstanding means how much days a particular debtor is taking to pay the company back. So lesser the days, efficient DSO is, or good DSO is. That means company is able to realize its sales from its customers in a short span of time, right? So organizations can reduce the DSO by establishing clear-cut policies, entering agreements with the vendors, and conducting regular follow-ups or the checks for the payments. However, proactive follow-ups and the use of digital tools can also be used as one of the important step to reduce the DSO. Here, one thing which I want to highlight is that firm should maintain a balance between these two. It means that the credit policy should not be stricter and it should not be lenient, because if the credit policies are stricter, then it may affect the overall relationship with the customers, and if they are lenient, then it may impact my working capital, or it may lengthen my working capital cycle, right? So now moving on to the next concept, that is a payables management. Accounts payable represents the company's obligation toward its suppliers. It means that the payments that company needs to pay to its vendors, which is commonly measured through days payable outstanding, that is DPO. A higher DPO means company is taking more time to pay to its vendors, although it helps to conserve the cash on one hand. However, it may also impact the relationship, or it may strain the relationship which company is maintaining with their suppliers. So again, company has to maintain a balance between the policies which it may have between with the vendors, like however, company can use certain steps, likewise leveraging the early payment discounts, wherein if company is paying a vendor before the days or before the agreed credit terms, then company may take a discount from a vendor for early payment, and then in a way it may impact give a positive impact on the working capital requirement. So after understanding or a brief discussion about the DPO and DSO, in a simple terms, we may say that the objective of the working capital management is to collect the cash faster from the debtors, turn or pay the suppliers quickly so as to maintain a balance between these two. Beyond these core concepts, working capital management also involves the cash flow forecasting. Accurate forecasting is very important because it gives the management an idea that how much cash it may require in the coming future, probably in a span of 1 month or 2 months, or if in a situation how much shortage of cash is being forecasted or is being predicted in the coming period, so that accordingly such funds can be arranged in the form of debt or in the form of short-term financing, so that it is not affecting my company's operation in a short run. So such decisions can be taken with the forecasting techniques in an efficient and effective manner. In all these scenarios, technology plays a very important and vital role. Tools such as ERP or data analytics and other platforms can help a company to take a decision in a better form and to run the operations in efficiently and effective manner. So, from a practical perspective, working capital management requires close collaboration between all the departments. By all the departments, I mean be it procurement, be it sales, or be it finance, or be it operations team. So, working capital management is the joint responsibility of all the departments. It is wrong to say that working capital management is only the finance's responsibility, right? So, because sales team needs to align with the credit policies, procurement team must align or must negotiate the favorable terms with the suppliers, and operation teams must manage the inventory efficiently and effectively, and finance acts as a central function that integrates the all the efforts of all other teams in optimal outcomes. So in my professional experience, effective working capital management has been often act as a key driver for overall operation efficiency and profitability of the business, whether it is improving receivables collection, optimizing inventory levels, or managing inventory operations. Small improvements in a working capital can lead to a significant improvement or can have a significant financial impact. For example, even a reduction of 1 day in DSO means if my debtor is paying early even by a 1 day can have a significant impact on my cash flows, and that excessive cash flows or that excess cash that we have received even a 1 day in advance can be used can be redeployed for further growth of the company, or can be used for the payment of any short-term financing that company may have taken for the purpose of operations of the company. So to conclude, working capital management is not just about managing short-term finances or the cash. It is about creating a financial ecosystem wherein which is primarily focusing on the shareholder wealth maximization. So, in a nutshell, working capital is very important and a very, you can say, a key driver which is being monitored constantly by the finance professionals to give a fair way to the management that how we can manage the business operations efficiently and effectively. Because, as you know, cash is regarded as the blood of the business, and without cash, a firms cannot sustain operations, and operations can't be run in an efficient manner. So, this is my discussion of the working capital. Thanks a lot. Thank you.